All right. Welcome to the Market Pulse podcast. I'm your host, Emmaline Aliff, leader of the Equifax Advisors team. This group identifies economic considerations and leverages data and analytics to translate into industry insights and recommendations, supporting our clients during economic uncertainty while uncovering growth opportunities in consumer credit risk. I'm pleased to welcome back our Market Pulse guest, Amy Cutts, and our panel of experts, Maria Urtubey, Tom O'Neill, and David Sojka. This month, now that we have Amy Cutts on, we're going to just jump right into the questions. Let's start with discussing hard versus soft economic data. So first, I'd like to ask Dave, how should we be thinking about consumer sentiment and how much it matters?
Right. So we'll start off with that soft data point right away, sentiment. How consumers, how businesses are feeling, right? So recent University of Michigan and the U.S. Consumer Confidence Board gauged, how Americans truly feel about the economy currently, as well as in the future. And the most recent results are the following. Less positivity about the current business conditions this month than in May. Consumers' appraisal of current job availability weakened for the sixth consecutive month, but remained positive in line with the still solid labor market. The three components of the expectation index, business conditions, employment prospects, and future income all weakened. Shifting over to the hard data, here's what's key. Keep an eye on originations, credit usage, and delinquencies to see if this soft data opinion feeling turns into actual behavior.
Amy, what do you think? What would you add to that?
Yeah, the soft data aspect, I think it's worth just reminding people what we mean by that is, things that come from opinion surveys or small sample surveys. So it's not that it's not valid, but it would be not necessarily representative of the whole because it, might not be balanced in the right way. But, I think importantly, the soft data, and it doesn't matter whether I'm talking about National Association for Credit Management, Accounts Receivables Credit Manager Survey, or a National Federation of Independent Businesses, Small Business Expectations Survey, or consumer sentiment, these kinds of surveys, they're all pointing to weakness. And that's been a pretty steady drumbeat for a while. And yet nothing to see here in the hard data. It's been consumers are spending, and so GDP's up, except for the big influx of imports that we had. Absent that, GDP would have been positive. The unemployment rate's still low, rising, but really low. Net payroll employment still up. Small difference in payroll unemployment claims on a weekly basis, but not like recession levels, just a little increase. We saw a huge increase in layoff announcements, but that's almost like a soft data point. It's required by the WARN Act, but it's an intention. It doesn't mean necessarily that it happens immediately. The numbers have been scary. I think it was like 17,000 people at UPS and like 5,000 people at Microsoft. Big numbers, but those are not showing up in the layoffs data. So there's this tale of two stories here. The soft data says things are terrible or going to be terrible, and the hard data are like, not yet. So it's frustrating to be in the business of forecasting in that environment because it's really hard to get a handle on it.
Yeah, it is. I definitely empathize with your frustrations around forecasting some of the things in the environment, especially if there's expectations of things happening and then behavior changes, which can have some additional impact. So let me take that similar type of perspective and ask the rest of the team. Tom, Amy was talking about things like the economic policy, tariff, interest rates, et cetera. And we know, the economic policy can then feed into whatever the interrelatability is to the soft data for sentiment and the hard data for, any other things that we're observing from the economic perspective. And then that carries into what we observe in credit data. Maybe you can weigh on some of that as well.
Sure. And Amy did a terrific job of laying out what we mean by soft data. I'll try to do the same thing with hard data, which is kind of the opposite of what she described with the soft data. Soft data being that qualitative survey-based feeling information, which again, important, but it differs from hard data, which is quantitative, objective, measurable, repeatable, or verifiable. And the short answer to your question is yes, but it depends on where we look in terms of, is this showing up in hard data yet? We do see, hard data. So the effective rate of tariffs is now roughly 9 times what it was at the beginning of the year. It's almost 20% at this point. And we do see things showing up in the business behavior data in terms of the upfront, purchasing that we've seen, changes to capital spending and so forth. But what you're probably referring to, narrowing in on, more specifically is, how is this, impacting the household level, the consumer level? Is this showing up in that hard data in terms of increased delinquencies, card payments, things like that? And there, we're just starting to. It's very early on. It's not at a point where we can look at a series of trends and say conclusively this is the impact of policy or anything like that. But we are starting to see changes in consumer spending behavior and some of the things that are slowing down, as maybe a combination of both the sentiment as well as some of the hard economic facts are actually starting to take effect at a household level.
Yeah, thanks for sharing some of that, especially taking it down to the consumer level, because when we think about the impacts to the consumer and how that will ultimately impact a lending environment, that's usually where we try to come back to. And so I'm going to pose this question to Maria because it came up as one of our poll questions this month in Market Pulse, which I thought was very insightful. And so maybe Maria, you can chime in on all the things that Dave, Tom, and Amy just shared with respect to, are lenders generally take a net tightening or net expansion posture in the current environment?
Thank you for sharing. We have seen lenders tightening strategies for a couple of years now as a result of delinquency trends. And now, as you were mentioning, Em, we're also seeing some are aligning to the business as usual, as per the poll last week during Market Pulse. We're also observing consumers pulling back. So we're hearing the term collective cautious approach. So it's a little of both. We see, for example, the origination subprime share shrinking, except for auto and bank card, or keeping to very low levels. So, for example, while it's 14% of the originated balance share in the case of auto, which might seem quite reasonable, it's only 3% of the originated limits for bank card, which is one of the products that consumers rely on the most to make ends meet. And we also know consumers are preparing to buy less for more. So there's both lender tightening in some cases and consumer pullback.
Yeah, thanks, Maria. And as you know, I do like to dive a little deeper below the surface, and so let's do that even further here. I think where I'd like to go next is specifically, going back to the top of the macroeconomic level, and I'd like Amy to, weigh in if she can, specifically on where are we right now with tariffs and what is the current potential future impact that might be coming.
Yeah, so there's I think 3 parts that are worth noting. One is the uncertainty of the tariff policy. So Tom mentioned that tariffs are about they're like 19.7% right now, which is, we were at 2.8% before the start of the year. And that was inclusive of the 2019 tariffs that went into effect. So, that was already much higher than it had been. But importantly, that's the effective tariff rate today. But before this tariff rate took effect, we knew it was coming. And so lots and lots of people who are in the import business or who rely on imports front loaded. And so they brought a lot of stuff in. As long as they could find a ship, they threw as much on it as they could. We are now in using down that inventory. So the reason you're not necessarily feeling it at the store, whether it's online or a physical shop, is because a lot of that stuff was brought in before the tariffs went into effect. Now, we're burning through that inventory, so we're starting to see a bigger impact. The next thing is that the president has said that, August 1 is the new tariff day. So that's when, if you don't have a deal in place, you're going to get smacked with new tariffs. And that's fast approaching, right? I mean, we're just a few days from the end of the month. Now, what'll happen then? Will it be extended? I don't know. It makes it very hard for businesses to figure out what they're going to do as that deadline approaches. So that uncertainty, I think, is a critical piece as well. So the absolute level of tariffs is a little scary. What's that going to be? But it's the uncertainty. I can't, if the tariff is 30%, I can make a decision whether I can keep my business going with that or try to find a solution that works better. But if I don't know if it's going to be 10%, 20%, or 50%, I'm just going to be putting everything on hold. So I think the uncertainty has another element. We're in earnings season now that the quarter's ended. Stellantis yesterday and today GM announced earnings, and we're pretty negative from the impact of the steel and aluminum tariffs, which are much higher, right? They're 50% right now. And U.S. steel manufacturers have increased their prices now that the tariff policies are in place. They have a little protection to do that. So, that's starting to feed through. If you haven't bought a car and we're thinking about getting a new car, I'm going to bet that the prices are a lot more expensive. So that should feed through. When Maria gives an update or Dave gives an update in a couple of months on the Credit Trends webinar, I'm going to bet that that's going to affect originations somewhat, that we'll see higher balances on those and fewer numbers of cars sold.
That's really interesting. I think I do want the rest of the team to weigh in as well, just on some of the things we might be observing. One thing I'll add, to start off with, what I find kind of interesting, thinking about small businesses in general, is we've had a few discussions just on what areas may or may not be impacted the most. And a place like a yoga studio, if that's a small business is running and their cash flows, nothing has to do with imports, so there's nothing that's being tariffed necessarily, unless they get new equipment from somewhere or things like that. But then you look at coffee. If you look at like a small coffee shop, nearly 99% of that coffee is going to be imported, and you will have some different impacts. So I think it's really important to look at the nuance, so we can say the effective tariff rate, but what does that mean to the very specific industry? So I offered a few examples. Maybe team, you can weigh in as well.
Yeah, I'll start off with auto. So Amy highlighted a couple of the areas, but really, so again, we have that post-tariff slowdown, right? So we had a surge really, ahead of the anticipated increases in the end of May or June. And so consumers rushed to buy before that took effect. So June saw a noticeable cooling of demand. Price increases. So June's average new car price was up slightly. Many analysts are predicting, as manufacturers are dealing with the tariffs, as Amy pointed out, aluminum and steel, that's going to impact cost. And one thing I saw, 92% of entry-level cars priced under $30,000 are made overseas. And those are the ones that are going to be hit, hardest by tariffs, and ultimately affordability for those consumers on the lower part of the K might also be impacted. Yeah. Inventory challenges, right? So again, trying to manage inventory as sales slow down. And again, the uncertainty that Amy highlighted really, kind of precluding businesses from doing that as effectively as they should. The Stellantis loss just was mentioned this morning, in terms of that was related to tariffs, and really kind of the long-term impact, I would say, is, still unfolding. I think that, the story's still to be written. Analysts are expecting, more severe, impacts in the second half, right? I think, we've got this. Is it gonna impact? Is it not? Is it this year? Is it next year? So I think there's still a lot of indecision in terms of if and when we'll see that full impact.
Right. And Dave just went through a great example of the auto industry, but to your question, Emmaline, in terms of how does this impact specific industries, rather than take another specific industry, I'll sort of address it from a more generic standpoint. It really depends on the details within there. I like your yoga, example. The service industries might be impacted, one way compared to manufacturing. But even within those different industries, what is the manufacturing? What are the options for those players within that industry? Are they reliant on materials coming from outside? Can they pivot to something domestic? What are their inventories? What are their other options? So it's more nuanced than just saying, this particular industry relies on this particular import that's going to be impacted by a tariff of X%, because that's not counting the other options and variables at play, which makes it a lot more interesting.
Let's turn to interest rates then, because I think if we, one of the big topics that we, consider with respect to tariffs is change in price, and change in price can impact, what does the Fed do with interest rates, which, carries through to almost everywhere we work in this specific industry. So, what are the arguments both for and against lowering rates, Amy?
Yeah,
and maybe a follow-on to that would be, what economic impact could it have?
Yeah, so I can tell you that there's one job I wouldn't want right now, and that's Chairman of the Federal Reserve. Jay Powell is, has been, I think, a great leader of the Fed. And whenever economic conditions are not ideal, this is not unique to this presidential administration. Presidents like to lean on the Fed and say, hey, do your job and help me out here. And the Fed has, the tradition of saying, yeah, that's not my job. And Powell has reiterated, that's not my job. There's kind of two competing things happening right now. The Fed has two really important levers that they use. The one is the Fed funds policy rate, which is every 6 weeks when they meet, the big announcement, did they change interest rates or not, along with the statements that they make that can help move markets. And then there's a different kind of intervention that you might remember that they called quantitative easing or quantitative tightening. And that has to do with whether the Fed is buying or selling, or sort of actively buying and selling, or passively allowing runoff of their massive portfolio. That prior to the Great Recession, I mean, it seems like ancient history now to go back to 2008. But when the financial crisis hit, the Fed went from having a very small portfolio of Treasury securities that they sometimes would go in and intervene if they felt like there was a little bit of market turmoil, but it was really sort of a non-entity, to being, trillions of dollars of investments in Treasuries and mortgage-backed securities. Then again, when COVID hit, so they had been in runoff mode. Then, so a very passive quantitative tightening. Then came COVID, and again, financial market turmoil. They jumped in, bought more securities. They provide basically a floor for these fixed debt instruments. Well, what we've been doing, even though the Fed funds rate they lowered for a while, and now they're holding steady on the Fed funds rate, that's the policy rate, they have been passively allowing that big portfolio to run off. So when you pay your mortgage, the principal payment, part of that goes to investors in mortgage-backed securities, the Fed being a big investor, that $1,000 or so that goes towards your principal pays it. That's the runoff I'm talking about. Or if somebody pays off a mortgage, that's another form of runoff. And then in the Treasury portfolio, it would be as those bonds meet maturity and pay off. So it's from that standpoint, the Fed is on one sense doing nothing, and on the other one tightening a little bit. Now, we just passed this massive budget bill, right? The One Big Beautiful Bill Act, and that has the potential. I mean, the estimates from the Office of Management and Budget are coming in and saying this is going to raise by trillions of dollars the deficit. I know you wanted to reach that a little bit later, but my point of this is that we have a pretty good economy. We have inflation that had been until this month coming down, right? Until this month, meaning the June report, coming down. And that would indicate normally to markets that you can ease off a little bit and lower the treasury rates, the market treasury rates. But the markets have said, not on my watch, right? They're looking at this at addition to the deficit. And especially some of our foreign investors have not been so anxious to buy treasuries. We had a failed treasury sale, not failed, it didn't completely fail, but it didn't have very many subscribers, and that sort of roiled the markets a little bit. So, markets, the Fed can lower the policy rate, which is an overnight rate that banks charge each other to balance out their ledgers. They can lower that, but the markets that that are setting the 10-year treasury rate, on which mortgages and autos less directly, but on which a lot of consumer debt is based, the markets are saying, we don't care. We're looking at this looming deficit problem, and they're not lowering that. So the important point of this, what does it mean for consumers? Well, if I'm buying a house, it's less affordable. If I'm buying a car, already tariffs have raised the price. Now I'm paying a lot for borrowing. Now, when it gets harder to sell a car, what do car lenders do? They give you 0% financing. They offer some other incentives, and we are seeing some of those incentives come back. But bottom line, they can't do that for very long if interest rates remain high, or if the tariffs are causing them to. They can't lose money on the sales of cars for very long. So I think that it's going to have a big impact on consumer. These big durable good purchases that are expensive. I don't see a way out of that, because unless the Fed really intervenes with quantitative easing, and I don't see the Fed doing that, consumers are not going to find much affordability out there.
Yeah, that was a great pivot and transition, Amy, heading into the household level. So without further ado, I would love to, get right into some of that stuff with, especially when we've been talking about the K-shaped economy, taking effect in how are we observing some of that occur in credit data? And maybe we'll start with Tom on this one.
Sure. And let me just, for our listeners who haven't heard us, as we've talked incessantly about the K-shaped over the last couple of years, just a brief explanation. It is what the name implies. It's a visual representation showing how, given different economic conditions, some populations thrive. They're on the upper part of that visual K. And other populations certainly are struggling, and they're on that lower part of the K. So if you imagine an arrow going up and an arrow going down, it's as basic as that. And of course, when we talk about that, there's always been that case. There's always been the situation where there are households that are thriving and households that are struggling. The reason that this is so much more of a focus and why it's more of a talking point is that gap between those two arrows, those two parts of the K, it has been growing. And we see that in a number of different ways. Emmaline, you asked, do we see that in the credit data? Yes, we see that in the credit data. We see it in things like even average credit scores. We see more people rising in credit scores, and we see at the same time more people lowering in their credit scores, going down in credit tiers, maybe going from prime down to subprime. And you wonder, well, how that's paradoxical. How can that happen? Well, the reason is there's less people in the middle, so to speak. Some people are trajecting up, some people are trajecting down. And what's interesting is that we don't just see that in the credit data, but we see that within wealth trends as well. We see that there is, over the last few years, a large portion of the population that have benefited, from investment wealth, from housing wealth, as their houses, over the last 5 years have increased in value, and equity builds up and things like that. And on the flip side, we see it. We see a population that's not increasing or even decreasing, and part of that can even be boiled down to, when we look at overall wealth, we see the mean, the average wealth at a household level increasing, but the median not increasing, staying the same, or in some cases even lowering. So we're seeing the proverbial rich getting richer, and more people falling under that median at the same time. So that gap, as I mentioned before, is broadening. And I'll give one more example before letting others chime in. Even from a behavioral standpoint, we see things like credit card payments. We see more record levels of people making the minimum payments on their credit cards. So they're paying just enough to get by, to meet the minimum requirement without being dinged. And at the same time, we still see near record number of people paying off their credit card balances in full each month. Our typical transactor crowd that use their cards and pay off the full balance each month. So we're seeing this K-shaped behavior in a number of different ways, not just in the credit data.
So we have seen, some commentary on that bottom end of the K when we think about like those consumers experiencing subprime credit, for example, card delinquencies. We've seen some slight improvements in that, which almost feels like counter to some of the points that Tom was making. Dave, maybe you can offer some perspective around that.
Yeah, thanks. So, sneak preview for our audience: our June data is freshly out, and we have another month of improvement in credit card delinquencies. This is 6 straight months of improvement in card delinquencies, and part of this is seasonal factors. Tax refund season from January through June allows consumers that receive those refunds this year in particular better than average returns from many U.S. consumers, allow them to pay current on those past due accounts or pay off those existing debts. Another factor Maria touched on, lending behavior tightening, right? So I just want to touch on the why of that. In looking at our data, and as we've talked to many clients, cards issued in 2022 and 2023 have the worst performing vintages over the last 7 years. In response to those two vintages, starting 2024, many lenders decided to tighten their lending standards to reduce that delinquency from those two particular origination periods.
Maria, so I know you've been spending a lot of time in our group around derogatory student loans. Can you talk about some of the potential hard data impacts that are occurring there, specifically even how it fits within payment hierarchy?
Yes, thank you, Em. And I've been sharing some of the payment hierarchy implications. I don't expect that to change. And going back to the bottom part of the K-shape that Tom addressed and the hardships that those particular segments are going through, if they have an average auto loan of 750 as the recently originated averages, they're not going to prioritize the student loan amounts over the car that gets them to work. We are seeing in the delinquency trends, for example, the student loan delinquency trends softening in May, but that's after peaking that month. And peaking meaning they've been the maximum and in both the $90 or more days past due and also the number of accounts that are 90 or more days past due over the last 20 years that I've been looking into. So there's a concern. As Dave was referring to credit trends, the new reports were published yesterday, and we do see slight improvement in the June data. The $90, for example, metric stands at almost 18%. It was, again, 18.7 in May, so it's getting back to the April numbers. The number of accounts stands at almost 24%. It was 24.7 in May. So we're seeing some improvement, but we're also, if you recall, collections resumed in May. They were paused. We're expecting more activity on garnishment at the end of the summer. And although those might act as deterrents, we know that again, the individuals at the bottom of the K that are faced with an additional payment now reported and affecting their credit scores will only mean more to juggle and even an impact to their affordability possibilities. So more for them to deal in an already unaffordable scenario.
Yeah, thank you for that. Amy, we talk a lot about cash flow in general. And when we think about cash flow, there's, of course, the, things that are coming as an income, and then there's debts. When we aggregate that up to a national level, maybe you can weigh in on this specifically with at what point could the national debt adversely affect the economy?
Yeah, so there's boy, there's entire schools of economics to talk about this. Modern monetary theory, as cynics might say, is it doesn't matter. But I think that there is a limit to what global investors will do. When you're talking with your kids or your friends who are thinking about buying a house for the first time, I think the traditional advice is that your debt should be about 30% of your income or 3 times your income, right? We kind of do that back of the envelope thing because you got to eat and you got to pay all the other bills. That would be great if countries also sort of followed that. But we've kind of pushed that envelope over time such that in 2012, US debt to GDP, so GDP is the income of the country. You think about all the stuff the value of all the things that we made and the services provided, that's the income of the country. Well, in 2012, the national public debt, now this would include state bonds and so forth, but it's the national public debt was equal to a year's worth of GDP. That's a pretty high rate. And since then, so that's 2012, just not all that long ago. In 2025, the good news is it's come down from a pandemic peak, but we are at 121% of GDP on our debt. And we just proposed adding through the one big beautiful bill, trillions of dollars more to that. The thing about deficits is they're cumulative, right? But in any one year, if your sort of budget relative to your what you actually spent relative to your income or what you budgeted for, if it's a little bit negative, that's okay. We'll just take from savings or borrow from friends to make up the difference. For a long time, maybe some of you took an economics course back in the day and you learned about John Maynard Keynes, and he talked about how when times were bad, spend lots of money, governments, right? Make sure that the unemployed have a floor, feed the hungry, do lots of social programs during bad times so that when good times happen, those people get jobs, the tax base increases, profits return to companies, the taxes go up, and you pay that down. So it's kind of like an automatic mechanism. Starting in 2017, we got off of that mechanism with respect to deficits versus the unemployment rate. And since then, the unemployment rate has been falling and our deficit's rising. And I'm excluding from that the COVID period. The COVID kind of did the same thing. We spent lots of money, and then after we spent all that money, the taxes and the economy got back on their feet, and we kind of got back to lower deficits with a lower unemployment rate. But we're now in a situation where, unemployment rate is about as low as it can be. Economy is on paper at least pretty darn good, and the deficits are growing. I think it's awfully hard to attract global investors into the U.S. when you're looking at that balance sheet relative to another country where I might want to similarly invest. So now the one thing we have going for us is that lots of other countries are also running up big deficits, but nonetheless, that's not a really good way to argue how to run things. But it could potentially, I think, be costing us higher interest rates. So kind of going back, bringing it down. That's the aggregate number. Bringing it back down to households. That's the debt that we owe and that our children will owe over the future. Inflation helps a little bit to diminish that pain, but not enough. And ultimately, if you're trying to borrow to buy a house, things have not been in your favor, the last couple of years. So I don't see, again, kind of bringing it back to interest rates, I don't see interest rates coming down in the near future. not really a relief valve for people thinking to refinance or buy a house. And that, it's kind of putting the economy on pause from a consumer perspective.
Okay, as we're closing out with the Market Pulse podcast, maybe everyone can give me one line on what are you tracking or closely monitoring for the remainder of 2025?
I am very interested to see if wage garnishment does come into effect on any scale of consequence on student loan delinquencies, what the impact will be on those payment hierarchies. Maria mentioned, these are already going to be an additional stress on those at the bottom part of the K who are needing to juggle their income with making car payments and not wanting to stop those car payments so they can get to the job to get a wage. But if those wages are being garnished, then how does that all come into play? And the reason I'm so intrigued is that we are still talking significant numbers of households that have student loans. Student loans are bigger. Yeah, student loan debt is still bigger than credit card debt.
I will add, paired with the student loan, of course, affecting so many consumers, affordability for housing in particular. Going back to what Amy was explaining on the rule of thumb of the 30%, that's not what individuals are now asked, and some are not even qualifying for these high prices. So that's one thing I'm watching.
I'm focused on the auto industry, specifically delinquency with $1,000 monthly payments, lower down payments, less incentives for 0%, more stress on the consumer on top of the student loans and other pieces that we've touched on today.
Amy?
Yeah, I'm just following consumer spending. The sentiment index, if you look at it by incomes, because getting back to that K idea, even the very high third income group was saying, no, things are not looking good. And so I'm waiting for that shoe to drop. And so I'm really watching consumer spending.
Thank you. And I'll close this out. I'm watching interest rates because it has probably one of the biggest impacts in terms of our business from an origination standpoint, and that carries through to any form of revolving type of debts that are impacted by that as well. So thank you for joining us today in our Market Pulse podcast. I'm Emmaline Aliff with the Equifax Advisors.